So yeah, I mean, part of the problem when someone does have to do something formal like a proposal or bankruptcy is that the both the office of the superintendent of bankruptcy as well as your creditors will report the fact that you've had to, use some sort of insolvency process to deal with your debt problems, and of course it leaves a negative report on your credit report. And one thing I would just say as an aside, there are some things that you can carry through those processes. So things like car loans, secured loans. If you have those, great. If you can continue making those payments, no problem.
All right, Wesley, how are you doing again today? And I'm excited to have you here. This is our second time doing this.
Yeah, well, it's great, Gary. I appreciate it. Thanks very much for having me.
Yeah. So listen, I mean, there's a lot of things happening in the market. It's obviously shifted. I think we did this about a year ago, right?
Pretty close to that, I
Yeah,
think.
close to
Yeah,
a
yeah.
year. And we met at a very interesting and fun dinner with some very key and very, I would say, smart people as well, too. It was unfortunate that it fell off, but hopefully we can get it started back up again because I thought it was very educational and just seeing different people in different industries and what they do and learning from them.
Yeah, for sure. And how they intersect with each other. Like you said, I think earlier we talked about that, sometimes you don't realize just, what people do and sort of how far that, they're involved in things and how we can benefit each other just by knowing those things. Right. So,
yeah, absolutely. Yeah. So we're having this conversation today because of the shift that's happened. And then, we'll get into what you do. And I really want to kind of dive into three sections. So one is, like what it is that you do, the service that you provide at MNP. I also want to dive into what are you seeing in the marketplace? Like, and also like, what are some of the alternatives outside of just bankruptcy? Because I'm sure there are. Mm-hmm. And then I obviously want to leave the listeners with some strategies. I want to give them some ideas and tips in regards to when it comes to repairing and fixing their credit and some next steps. So why don't we kind of just dive right into it? So what is it that you do at MNP? And also, too, what is a licensed insolvency trustee?
Yeah, sure. It's a phrase that not a lot of people are familiar with, and we used to have a different title, which was trustee in bankruptcy, and then they changed it a few years ago to licensed insolvency trustee. I think to better reflect what we do, because we don't only do bankruptcies, so that's the thing. But just to back up a step, so just in terms of MNP itself, MNP is primarily an accounting firm. We are coast to coast. We're the largest Canadian-owned accounting firm, and if you're a Blue Jays fan and you look down the third base line, you're going to see our big billboard at the back there that sometimes the guys run into trying to catch some fly balls. But part of our business, in addition to the accounting side and the business building side of things, is the insolvency side. And so that's where I fit in. And so I am what's known as a licensed insolvency trustee. There's about 1,000 of us practicing in Canada, and which I know it doesn't sound like a lot. And when times are tough and there's a lot of things going on, it's probably not enough. But the federal government licenses us individually to do any range of formal insolvency proceedings. So whether it's a receivership, a bankruptcy, a proposal, or even some of the big stuff that what we know as the CCAA, which is kind of our version of Chapter 11 here in Canada. So that's the bigger stuff, the Air Canadas, the Stelcos, all that kind of stuff. One of us is involved in it, in all of those kinds of proceedings.
Yep.
So there, in terms of that process, we are again licensed. There is about a 3-year study process to become a trustee, and we're vetted and all that kind of stuff. So we typically come out of either the accounting profession or the legal profession. I'm more on the legal side myself, but it's sort of an intersection between the two. So yeah, that's basically what a licensed insolvency trustee is, and I'm somebody that people don't generally want to have to go and see if they don't have to, unfortunately.
Yeah, exactly. But the unfortunate thing is that sometimes, people do, even if they have full intent to never have to, sit down and meet with you or, anybody in the organization. But what do you typically see, people that come to you? What are some of the reasons why they do? Obviously it's financially, but what do you see? And maybe there's something that I may not have observed or understood as well.
Yeah, I think there's a bit of a misconception to a certain extent. I mean, as Canadians, are we carrying a bit more debt than perhaps we should on average? that's probably true. I think, it's somewhere, it hovers around the 180 to 185% in terms of the amount of debt we're carrying relative to our annual incomes on average. Now that includes mortgage debt, so it's not all bad debt, if you want to call it that, but it is pretty high relative to other comparable countries that we would look at. So we're a little close to the line. So then if something happens that upsets our financial situation, and that oftentimes is, an illness, a death in the family, a business failure, job loss, all those kinds of things, the things we don't plan for or expect, those are the things that kind of end up playing into the situation and causing us to have to, perhaps look at something more significant in terms of solving our debt problem. So a lot of it is things outside our control that I often see, coming down the pipe. However, certainly in the last couple of years, inflation and high interest rates have played into that too, which those were things we didn't really expect either. So that's another factor.
Yeah. And that's a good point as well, too, because I think sometimes people think, oh, well, they've just been careless, or they didn't really care. But a lot of times that's not the case. And many times they had, full intent to pay their debt back, or they were maybe, entrepreneurs and trying to make a better life for themselves. Or like you said before, like death or anything can happen. And all of a sudden now they find themselves in difficulty. So I guess the next question that I've got to ask is, like, if they do have to go through a bankruptcy, what is impacted when it comes to, say, like their assets, meaning like their home, their retirement funds or accounts, their car, or is there anything protected?
Yeah. So, and I think to sort of preface that discussion, I think I'll just mention that, I mean, certainly if somebody comes to see one of us, see an licensed insolvency trustee, we're going to look at the whole range of options that they've got. So we're going to start pretty high level, and we're definitely not going straight to bankruptcy. That's kind of a last resort, right? So we're going to look at other options, whether it's refinancing or whatever the case may be. And also then another step above the bankruptcy process is the consumer proposal, which we can talk about more a little later. But that's another option for people to resolve their debt problems without having to go into bankruptcy. And the advantage of the proposal is you're not giving up control of anything you own. In a bankruptcy, technically, you're assigning what you own to the trustee for the benefit of your creditors. So the trustee's job would be to liquidate certain things and pay the creditors as much back as we can. However, there are a lot of exemptions, and this is laid out. Although the bankruptcy process is federal, they kind of defer down to the provinces for these exemption thresholds. And so, there's a significant exemption on household furnishings and contents. It's around $14,000. There's an exemption on a vehicle that somebody can claim. And there's a number of things that you get to keep, including things like RRSPs and pension plans and things like that. Typically, for the most part, you're keeping those things. So I think people have a misconception in a way about bankruptcy. They kind of assume that you're sort of left, sitting in the middle of your empty living room floor with a t-shirt on. And that's not usually the case. And that may just come out of sort of media that they see, or maybe another country's experience like the United States, which of course we see a lot of media from there. So.
Okay. So then what about their home, though, the home that they live in? So they get to keep that?
So that's where it gets a little bit tricky because, and this is where there's a little bit, I would argue, some inequality or unfairness perhaps from province to province, because there are some provinces in Canada where there is actually an equity exemption in a house. Technically, we have one in Ontario, but it's very low and it very rarely ever comes into play. So the problem is that, especially given the rather meteoric rise in house prices, which are still kind of holding, we're not seeing it fall back to pre-pandemic levels. People have equity in their homes, and sometimes they can't extract that equity very easily because maybe the lender says, look, I'm only prepared to go up to 80% loan to value or something like that. And so then they're sitting there kind of, house rich, but cash poor. So the problem in a bankruptcy scenario is that if, you couldn't find another way of sort of getting that equity out in order to help pay your unsecured creditors, then the trustee would be in a position where, we'd have to see that the house got sold and the equity divided up accordingly. But certainly we try to work with people and find other solutions, and sometimes refinancing can work, and sometimes it's only one spouse that has a lot of debt and the other one doesn't, and there's a way then to be able to borrow enough money from that equity in the house in order to satisfy the unsecured creditors.
Right. Actually, you know what? That leads into another good question as well, too, because what if you're married or you're common law, and I'm not sure if there's a difference here when it comes to going down this route. What if only one person files bankruptcy? How does that work?
Yeah, so interesting there. Of course, normally with spouses, a house is jointly owned. So you're going to have basically a 50% ownership stake for each person. And
Yep.
so therefore if you calculate equity, which, from our perspective, it's kind of, what's the fair market value of the house, less theoretical selling costs, less the mortgages that are there and accounting for some early discharge penalties, that kind of thing. What's that number that's left? And then it's kind of a 50% of what's there would be attributable to the bankrupt person. And I've certainly had cases in the past where the non-bankrupt spouse was able to pay the amount that the bankrupt spouse, their equity was, their 50% equity was into the bankruptcy, and then basically essentially buy that side of the equity out, if you will. So there's sometimes solutions to getting around these things without people having to move.
Right, right. Yeah, I'm like sink together or float together, right? Hey, I need
Fair,
some help here. I thought
fair
we're in this
enough.
together.
Yeah. Yeah.
Yeah, for sure.
And the thing is, if you're not bumping up against some sort of loan to value limit, it may be a situation too where together the spouses can borrow enough, either from refinancing or maybe getting a second mortgage or whatever, to be able to pay an amount into either a proposal or a bankruptcy for the person that's beleaguered by debt, to be able to get that taken care of. And then again, without losing the home. So,
Right. Yeah, yeah.
yeah.
Yeah, sorry. Yeah, so you touched on something there as well too. Do you see where that is also beneficial, where maybe they go into the private market and get like a second mortgage as a temporary solution?
Yeah, that sometimes works well. They that's an option for them as well. And then maybe down the road, when their first comes up for renewal or whatever, they may be able to roll everything together or something like that. And the trouble right now, as I'm sure we'll talk about in more detail, is that when someone goes out to market now looking for a mortgage, the interest rates are fairly high.
Mhm.
And that then when they have to look at it from a cash flow point of view, is that can they afford the monthly payment on the first mortgage and as well a second mortgage payment as well, right?
Yeah.
So
Yeah.
yeah.
And that's the other thing as well too, right? Is that yeah, you've got to be careful when you start going into that private market, and you got to make sure that there's also an exit strategy, because not everybody has your best interest at heart as well too. They see the equity there, and now they're potentially could be bleeding it out. So you just got to be careful. You got to make sure that there's a game plan, and whether it's like a 1 year term, where are things going to improve for you? Maybe you're going back to school, or maybe there's something that's going to change that that you just need to buy some additional time so you can get yourself back up on your feet properly.
No, exactly. And it has to be something concrete, not just wishful thinking. Because unfortunately, I
Right.
think a lot of people say, well, things will be better next year. And it's like, well, why? Is there a reason to believe that, sort of thing? And, I don't mean to be critical of people, but
Yeah.
we're optimists by nature. And I think that's a good thing generally, but sometimes our optimism overshoots our abilities or our financial capabilities. So
Yeah, for sure. What are the typical fees that the trustee would charge on something like this when you go into a bankruptcy? Does it vary? Does it change based on if it's one individual or a spouse, or depending on how large the debt is that they owe?
yeah, so there's a bit of so it depends on the process that we're talking about. If there's in terms of the consumer proposal and the bankruptcy, the simple versions of those processes, there's actually a government set threshold or a government set formula that basically would, depending on how much money is there to distribute to creditors, we're allowed to take a percentage out of it. If it's a larger bankruptcy file or a larger proposal file, then again, it's the same idea where we're basically, if there's an asset or some funds that are coming into the bankruptcy, we're allowed to draw a portion of that. And the federal government that oversees bankruptcies, which is called the Office of the Superintendent of Bankruptcy, they review our fees and all that sort of thing and approve them. And then on the larger files, we actually have to seek court approval as well. So, it's a fairly regulated industry, and we're, held to task to say, well, look, trustee, what'd you do for what you're asking to be paid, sort of thing. So,
Right. Okay.
yeah.
Okay. Listen, I want to kind of move into our second segment here, which is like, what are you seeing in the market? And then what are some of the different alternatives? So why don't we maybe dive into the alternatives first, just so that people can get a better understanding of the difference between a bankruptcy and a consumer proposal. And then how do you know which is the right one to go to? Because obviously, depending on sometimes who you go to, you may get different, uh, you know, suggestions of which one you should go through. And then how do you know which is the right one?
Yeah, it's a great question because I mean, sometimes it is a bit gray. There's a bit, I mean, potentially people can look at either option. And I mean, our obligation as like professionals is to let people know, well, how do they work and what are the impacts of each process? And, in terms of where you stand financially, which would make the most sense. And it's not even just a matter of, how much will it cost and how long will it last, but also things that people are concerned about as well. How will it affect my credit rating and for how long will that affect it, and those kinds of things. So these are all things that we would take into account when we're looking at, well, what's the best option. Now, I would have to say in general, proposals are a better option than bankruptcy, only because again, you're not giving up control of anything you own. We've in a proposal, what we're doing basically is we're looking at, well, in a theoretical bankruptcy, what would the creditors expect to receive, and in the and as well. So the proposal generally has to be better than that amount, whatever that is. Otherwise, the creditors would probably not vote in favor of it, which is a key difference too, that the creditors do get to vote in a proposal scenario.
Mhm.
But the other thing we look at too is your cash flow situation. Like, what do you need? How much money have you got coming in? What money do you need to cover your bills, and what's left, and what could you potentially offer up monthly in order to make some settlement with your creditors, which is effectively what a proposal is. You're saying to the creditors, look, I can't make all these payments as much as you want me to, or the interest is running amok here. I can't keep up with it, and I need to come up with some sort of a settlement arrangement with you. And a proposal can last as long as 5 years, so you can spread the payments out over a longer period of time in order to get to that settlement threshold that they agree to. But those are basically the ways we look at it, and in again, because of the fact that the proposal gives you more flexibility. Hopefully, for most people, their income goes up, so that means it's more affordable as time goes on. And again, you're not required to. Where in a bankruptcy, we're monitoring income and that sort of thing. And in a bankruptcy, if your income goes above a certain level, you're expected to pay more into the bankruptcy. Which in a proposal, once the creditors accept the proposal, if your income goes up, great, you've got extra cash flow every month.
Okay. So then let's talk about the bankruptcy a little bit more in depth. And like, what does that process look like? Like, is there like a one to kind of like a five step? Like, how does that work? If somebody was listening, like, can you kind of just walk us through that? What does that look like? I sit down, I come to your office, I'm like, okay, how does this work? And where does it start and where does it end?
Sure. So on the initial consultation, we usually ask people to bring us, some information so we can get a handle on where their finances are at. So we want to know, what's the income level of the members of your household? How many people are in your household? What are your normal expenses, whether that's rent, mortgage, utilities, all that kind of stuff, car payments. What do you own in terms of assets? Vehicles, real property, all those kinds of things. And then as well, what other obligations might be out there? Is there child support payments or something else that has to be made? And so we'll collect that information together. If it appears that it makes sense for somebody to do a bankruptcy, then we would get all the backup documents for that. So we're looking for obviously mortgage statements and opinions of value on the property or appraisals, all those kinds of backup documents that you'd expect that we would need. And then we prepare the bankruptcy documents, which interestingly, the proposal documents and the bankruptcy documents are very similar in most respects. Again, there's a income and expense summary, an asset and liability summary, and then some general questions about your financial dealings over the last few years in terms of, did you sell anything? Did you give anything away? Those kinds of things. Uh-huh. And then people are signing those forms under oath to say, look, this is an open book here. This is my financial situation. And I'm just being upfront with the creditors to say, hey, here's where things stand. Yeah.
Okay. So that's kind of the whole process there.
Yep.
Okay, got it. Now, I want to dive into the market piece of it now. So what kind of numbers are you seeing in regards to percentage, like from where we were prior to, we'll say, when interest rates were lower, the good old days,
to the good old
where
days.
they are now? Have you seen a significant increase? What does that look like? And I'm sure are you tracking that on a monthly basis, a yearly basis? Can you kind of dive into some numbers there?
Yeah, so it's interesting because just prior to the pandemic, there was the market was fairly decent, and of course we were experiencing lower interest rates then and that kind of thing. But our numbers in terms of the people that needed to access the insolvency system were fairly consistent with some of the couple of the previous years. Once we hit the pandemic, our numbers dropped off considerably because people were getting a break from having to pay their debts. Maybe they were saving some money because they couldn't go out and spend money the way they normally would,
Yeah.
and all those kinds of things. And then over the last year or two, the numbers have started to increase again. So certainly this year, we're probably getting closer to where we were in 2019 now, but it certainly seems to be on the rise. And what we're hearing is that people who have interest sensitive kinds of debt, lines of credit, that kind of thing, they're having to pay a lot more to service that debt. We haven't seen a big uptick yet on the mortgage side, because I think a lot of people, locked in in a 5-year mortgage, just a few years ago. But I sense a great deal of trepidation for those people over the next year or two when those mortgages come up for renewal, because if we don't see a significant decrease in the Bank of Canada rate, which people are hoping is going to happen, but I'm not sure it's going to happen fast enough for some people. And they may find that they are renewing their mortgage at a monthly mortgage payment that's quite a bit higher than they had previously.
Yeah, and that's going to be, I think, the tricky part, I think, for a lot of families, and also, we'll get into this as well too, investors as well too. I'm seeing it, I'm hearing it, where a lot of people are kind of getting to that threshold of like, look, I don't know where else I can pull money from, right?
Mm-hmm.
Do you see any programs coming out from the banks or from the governments to uh, potentially help the coming, we'll say, landslide? Because it's coming. It's like it's not like it's not coming.
Yep. Yeah. And I think probably the one thing that sort of sticks out, and I haven't sort of gotten a complete handle on this, but it looks like there could be the potential there for a longer amortization period, right, on mortgages. So instead of 25 years, maybe 30 or whatever the case may be. So that's going to reduce the impact of the increase in the interest rate, because at least your monthly payment won't go up quite as much as it might otherwise. So things like that. And I mean, now there's a difference between renewing and of course, new home buying, which we all know the things tightened up quite a bit in terms of the restrictions and limitations on how large a mortgage you can get and those kinds of things, the stress tests, right? So that's going to hopefully fix things going forward. But we still got this whole cohort of people that during the pandemic, there was this. I don't know, was that whole FOMO thing, the fear of missing out. If you didn't get your house now, it was going to cost even more next year, and you better get into the market because you may not get a chance later. And so unfortunately, that drove up prices considerably.
Yeah, listen, during that period of time as well, too, I mean, my phone would not stop ringing. Like everybody wanted to be a real estate investor. Everybody.
Yeah, for sure. For sure. Right. Yeah.
Very interesting time in the market. And all of a sudden you saw a lot of real estate coaches. And I'm like, what? You just started investing like a year ago. How are you a coach?
Yeah, exactly. Exactly.
And so you're right. There was a lot of the whole fear of missing out.
Yep.
And unfortunately, some people, a lot of people got caught up in there. And when interest rates go this high, you see the impact of it, or at least the coming impact that some people are facing now. Now, is there a certain demographic of people that you're seeing coming through? Like, do you see that there's more investors coming your way, or is it families?
Yeah, it seems to be more families at this point. I think investors, for the most part, I mean, maybe a little different in terms of their approach. They probably maybe are less, risk sensitive, because they kind of understood that they may make money or they may not. They have to sort of balance all these things when they're looking to make an investment like that. I would add, though, just sort of tagging on to our earlier comment there, just that there does seem to be a distinct change over the past few years in terms of how real estate, particularly residential housing, the opinion of it has changed. Because at one time it was, hey, this is a place to live for me and my family, and then it shifted to, hey, this is a place I can make money on. Right. That it was an investment. It was something that was going up so quickly that people saw it as a potential way of making money, making an income. But, unfortunately, that has sort of translated into us being where we are now, where there's a lot of folks who would love to be able to have a house and raise their family there, but they're just kind of priced out of the market right now.
Yeah.
So, it is in terms of who we're seeing coming in, though, it is more, homeowners, the residential and consumer side of things, less so the investors. But again, it depends on what happens in terms of these renewals that are coming, as to whether even some of those investors might be in trouble if they've got a bunch of properties where all of a sudden, in a very relatively short period of time, they're going to have a significant increase in the monthly payout. Right.
Yeah.
So.
Yeah, and the tricky part is that some of these investors that they bought like in 2020 or 2021, and unfortunately some of them, they've actually come back lower
Mm-hmm.
where they purchased it, and so now they're in this situation of some of them where they've put extra money in there to renovate it, to turn it to a 2 unit or a 3 unit.
Yep.
And now you got this double whammy of where the price of the homes are lower than when they originally purchased it.
Yeah.
So now they've got their hands tied. And so what do you do in that type of a situation?
Yeah, so there's these negative equity situations that we've run into, and we've seen this happen in the past too. In the early '90s, certainly in the 2008, 2009, we had some of that going on too, and that was just sort of that whole fallout from the subprime stuff. But I mean, it's a concern, and certainly in the past when that's happened, where some people realize that, hey, my house is not worth what I owe on it, then they kind of give up. They go to the lender, the bank, whatever, and say, here's the keys, kind of thing. I can't do this anymore. It doesn't make sense for me to do this anymore. So that's a real concern, particularly if you put money into the house and into the property in order to hopefully get a return on that, and then you find that things have fallen back. But what we're seeing too, the corollary of all these high real estate values is high rents, because now we've got rental income that we would have never imagined 5 years ago. I mean, I'm not even in the GTA. I'm out here in Kitchener, and people are complaining to me that their rent has doubled in the span of 5 years or something like that, right? Or if they had to move from one location to another, they found that they couldn't find anything at a comparable rent. It went up considerably. Yeah. So that's the flip side, is for the folks that have these multi-unit places. They're needing to get higher rents out just because they have higher costs that they need to, compensate for, and whether that's increase in the mortgage payments or just that, the value's not there in the property anymore. So they've got to kind of make their money some other way. So,
yeah, it is a very tricky situation. And I'll probably get a little bit of hate on this, but yeah, look, I mean, I see it from the investor side, and I also equally see it from the tenant side. Like, I couldn't even imagine paying $1,600-$1,700 a month, and all of a sudden now I'm told that I got to leave, and now my rent goes up to $2,600. Like, that becomes unmanageable, and you've got now this generation where they feel like they've been left behind, and they don't have any kind of an immediate solution. Like, hey, how do we fix this problem? Right? There's a legitimate supply and demand issue.
Absolutely, and that's part of what's driving it up, right? Is that there's not a lot of vacancies around, and so you pay a premium to get into a place that you want to be, and then again, some people are just forced by the nature of geography. I mean, where you work and all those kinds of things. Not all of us can enjoy just working from home. Some of us still have to travel to an office, and so you're trying to not have a long commute, and so it's a trade-off as to where you choose to live. But then, unfortunately, you're faced with high rents or high property costs, right? So,
right. I want to ask one last question here before we move into the last segment. Is I've heard of a thing called double bankruptcy. What is that, and is that something that you got to be aware of, not to put yourself in that type of a situation?
So I'm not sure how you understand the term. I mean, for me, it's more a matter of when someone files more than once in their lifetime, and we are actually seeing more of that now. So in the past, people, some maybe early on in their lives, they filed a bankruptcy. And the way the bankruptcy law in Canada works is that, unfortunately, there's no sort of statute of limitations on that. If you've ever filed a bankruptcy previously and you file a second bankruptcy, there are some additional things that you have to do. You have to stay in bankruptcy longer. If your income's over the set threshold, that the government set threshold, you may have to pay more in for longer, and those kinds of things. So I'm of two minds on that, in the sense that I think maybe there should be a statute of limitations. Like, if you filed bankruptcy 20 years ago, maybe it shouldn't be held against you now, because your circumstances are very different. It may have happened for a different reason.
Yeah.
But nonetheless, it is a thing we're seeing. And in my practice, I mean, I've been a trustee now for about 20 years and have been in the insolvency industry longer than that. And over the course of that time, there have been people who have had multiple bankruptcies I've seen. And now it's not that they're necessarily bad with credit. What those folks tend to be self-employed folks who unfortunately neglect the government too long where it comes to taxes, and they get too far behind and they simply can't make up that ground and get those taxes paid. So then they're forced into filing a bankruptcy.
Yeah, sometimes you look at it and you're like, maybe just there's a lack of that financial education, right? Not on their part, but it's like there isn't the education part. Because I mean, I think of like when I was in high school and going into the real world, I'm like, I didn't even know what a mortgage is and what that means, and taxes and insurance, and if I was to be an entrepreneur and how much tax I got to put aside, and like there's almost like this whole entire financial education piece missing.
Yeah, absolutely. And this has come up so many times in various conversations I've had, just that people, and even some of my clients say, I didn't benefit from any sort of financial education in high school. I mean, I learned algebra, but I'm not using that, but I could have used this kind of thing. Right. So it's maybe a lack of emphasis on the things that the nuts and bolts of life and how things, work. And even for the folks that are become self-employed, I think that there's a bit of a rose-colored glasses going on in those cases. They think, oh, I'm going to be my own boss. I can control my own time. I can do this. I can do that. It's like, yeah, but you take on a lot of other responsibility that if you work for somebody else, it's their problem, right? They're taking your taxes off and CPP and EI and all that stuff and doing all the bookkeeping around that. You don't have to do it. But, and I always say to people too, if you're going to be self-employed and, whatever you've chosen to do, that's what you're good at. Presumably you're not going to want to come home after a long day and do a bunch of bookkeeping. So, find yourself a decent bookkeeper or accountant and pay somebody to do it, because you probably won't, even though you think you will. So
yeah, exactly.
Yeah.
All right, so let's move on to the last piece here, which is like just strategies to repair and fix your credit and some next steps. And I guess I'll just kind of continue on with the whole financial education piece of it. Is there somewhere that they can go, or something that of? Because I'm sure within MNP, they must have some type of like, hey, this is kind of some of the next steps now, or maybe you should take this course. Is there anything that you offer or that you direct them to?
Yeah. So if somebody actually needs to file a proposal or a bankruptcy, part of that sort of rehabilitation, if you will, of that person's finances is there are 2 financial counseling sessions that are mandatory. We have to do with them. And it covers a lot of the stuff that we wish we got in high school, frankly. Budgeting, money management, effective use of credit, all of those kinds of things are covered in those sessions. Now, I don't expect to change the world with 2 1-hour sessions. I mean, it really does fall back onto the person to try to change any behaviors they may have had before that didn't work for them. But it does help. And certainly then there's other resources that we can direct them to that would help them out. And the federal government, the Office of the Superintendent of Bankruptcy, actually has the curriculum for those 2 counseling sessions online. So if people want it, even just go look at it, even though they're not in those processes, they can do that. And I think they did a pretty good job on them. There's a few kind of interesting videos you can watch and that kind of thing. And it can be helpful to kind of go through that stuff. But go ahead.
No, go ahead and finish.
Well, I was just going to say on the credit rebuilding side, that's another aspect that we talk a bit about, but maybe not as much as we could. And I'm happy to comment more on that if you're interested.
Yeah, absolutely. Please do.
So yeah, I mean, part of the problem when someone does have to do something formal like a proposal or bankruptcy is that both the Office of the Superintendent of Bankruptcy as well as your creditors will report the fact that you've had to use some sort of insolvency process to deal with your debt problems. And of course, it leaves a negative report on your credit report. And one thing I would just say as an aside, there are some things that you can carry through those processes. So things like car loans, secured loans. If you you have those, great. If you can continue making those payments, no problem. Then you actually have at least a positive credit score with respect to those creditors, which helps to sort of make your overall beacon score look better. But if once you come out of the process, it's always a good idea to check your credit report to see what's there. I know for certain that Equifax now has a link to a portal that you can go on to, and you don't have to pay a fee. It's free. You set up your portal, and you can go and look at the various credit reporting that's there. And sometimes we find that I think it's more oversight than anything else, but there's some errors, some things that aren't correct on there, and you have the right as a it's your information that's there. Equifax and TransUnion they're basically big data warehouses that serve the lenders. But if there's incorrect information there, you can request that it be fixed, and either ask the creditor to fix it, or you can put in a request yourself to fix those things. And I think that's fairly important to do that because, like I said, there are some artifacts, something that sometimes that sit there that need to get corrected or wiped off in order to help you rebuild going forward.
Right. Okay. No, that's good. That's good to know. When you are in a bankruptcy or when you're in a consumer proposal, when can you start fixing your credit? Is it different in each one of these?
Yeah, it tends to be different. The bankruptcy, you're usually kind of stuck until you get your discharge, your release from the bankruptcy. And so, I mean, that can be as short as 9 months for somebody whose income is fairly low, or it can be as long as 36 months for someone who's a second time bankrupt and has income above the government threshold. But those are sort of the span of times that we're talking about here. But once you get your discharge or release from the bankruptcy, then you can usually go and start doing some things to rebuild your credit and get new credit. Before you get your discharge, a lot of lenders will look kind of, askance at you and will want you to be done your bankruptcy. Interestingly, in a consumer proposal, it's not the same. While you're still in the proposal, there are some credit rebuilding strategies you can use, and you can actually start to rebuild your credit while you're still in the proposal. And then, so when you come out of the proposal, you've already got some positive credit scores that are going to help overshadow the perhaps more negative stuff that's been left in the wake of the proposal.
So for bankruptcy, you've got to wait till the end, and then you can start rebuilding because you can't get a credit card, I guess. Is that what it is while you're in that bankruptcy?
I'm not going to say it's impossible, but it's the lenders are less receptive to a request for it. And you do have to be upfront about the fact you're in a bankruptcy. So it's one of the rules in the act. So, if you go to get credit, you have to say, hey, by the way, I'm in bankruptcy. And, that might kind of shut the whole process down, unfortunately.
Right. Okay. And then if you're in a consumer proposal, and if it's a 3-year proposal, you can get a credit card. I guess what's one of the more famous one, like a Capital One or...
Yeah, and I don't want to advocate for any particular firm, but I have to admit Capital One does have they have a particular program that people can find online for folks that have challenged credit, and it would be secured or semi-secured cards. So you give them a deposit of some amount that they want, and ideally they give you a credit card with a bit higher limit than what your deposit was. So it is a functioning credit card. It operates the same way, and they do report to the credit bureau. It's not like these kind of cards where you're basically using your own cash on them. They are actually a true credit card. So you're going to get some positive credit scores there, assuming you're, using it regularly and paying it off, that kind of thing.
Okay. Now, I was always under the impression, though, that if you got a credit card while you're in a consumer proposal, your credit wouldn't start to get repaired. I thought you had to be finished the proposal, or am I wrong?
No, I mean, each creditor, each trade line, as you know that term, they report individually. So that new credit card will report to the credit bureau as being, a revolving form of credit. And if you're using it and paying it off every month, or at least making the minimum payment, you're going to have an R1 rating with respect to that card. And so overall, that will help your beacon score. Now, I'm not going to pretend to be an expert on how the black box at Equifax and TransUnion works in terms of figuring out where you fall in that 300 to 900 scale. And there are a lot of factors that play into that. But I mean, anything like that you can do will help your overall score for sure.
Right. Okay. So the sooner the better. So at least get a little $500 credit card and, just start using it and paying it off. And now, should you also keep a balance each month, or should you completely wipe it out?
Well, of course, I have a certain bias, I suppose, in these things. I would say pay it off, just so that you're not paying interest at a high rate, and it's not a bad habit to get into. And I mean, you can simply put your gas on it for the month for your car, and then just pay it off, kind of thing. And so things that you would maybe at the time would have used your debit card for, you just put that on, and just be mindful of how much you're putting on it. I mean, you may have a limit anyway you have to work with, but be mindful how much it is, so that when the bill comes in, you don't have any problems paying it off.
Right. What about being able to invest back in the stock market or real estate? Is there a timeline for that? Like, when can I actually say, hey, okay, I made my mistake. It is what it is. It's happened, or life happened to me. Now I want to get back into investing again in the stock market or real estate or whatever it may be. Can you just go ahead and start? Like, how does that work?
Yeah, so there's a big difference between bankruptcy and proposal where it comes to that kind of stuff. So in a bankruptcy, there is this rule, and I didn't make it up. So if somebody disagrees with it, they can talk to their member of parliament. But basically, if you're in a bankruptcy and you start doing things like investing or whatever, and it turns out that you make some kind of profit within that period of time, that could be considered income, but it could also just be considered an asset. Like if you make a capital gain on something you've invested in, and you're not out of bankruptcy yet, then that's considered an after acquired asset before your discharge. And the trustee would be in the unfortunate position of having to say, sorry, you got to fork that over, and it's got to come into the bankruptcy for your creditors. In a proposal, you're not bound by any of that. There's no asset aspect to it. So if you do, or you're in a proposal and you decide to invest and you make some money, that's great. I mean, you get to keep it. And if it's a capital gain, other than reporting it to CRA, you're golden. You can keep the money. So.
Right. Okay.
Yeah.
There was one other question that I wanted to ask that I thought was really important.
I would add one thing, just sort of going back to the consumer proposal a little bit. So the consumer proposal is as flexible as you can be imaginative in terms of the dreaming up the terms of it. So it's not a particular set formula. I mean, it tends to be monthly payments over a period of time. Yeah. But for some folks where they've got debt, but they've also got the ability to access some funds, whether that be through refinancing a property, or maybe there's a family member that's willing to give them a certain amount of money or whatever, you can make a proposal, a lump sum proposal to your creditors and say, look, you know what, I can pay, 40 cents on the dollar, 50 cents on the dollar, or whatever, and through a lump sum proposal. And basically that proposal will be finished within about 3 months, once all the sort of administrative side of it has to get done. And so at that point, that your credit rating will start to rebuild itself from that point on. And it stays on your record for about 3 years from the time you finish, but you've only had to spend 3 months actually in the proposal. So that can be a good option for people where there is the possibility of refinancing a property where maybe one spouse has a lot of debt and the other does not. And then you're able to access enough equity to make an offer to the creditors that's going to be better than a theoretical bankruptcy.
Yeah, that's a good point. So you get that cleaned up a little bit quicker. You got to family member that trusts you, and then you're able to, maybe pay them back, but you can get your credit moving a lot quicker, a lot sooner.
Exactly. Yeah. And that's actually an area where I see what we do and what a lot of mortgage brokers and that sort of thing do as dovetailing well, because it could be a situation where between, the two professionals, we can come up with an equity draw that will satisfy the creditors in a proposal and get that over and done with quickly.
Okay. I remember my question now.
Okay, good. I stalled it for enough time there that
yeah, thanks a lot. Yeah, sometimes it takes about a minute for my question to get back in my head, but I'm almost losing it again. But how does somebody, what is the biggest mistake that you see when people are they're in trouble, but they don't realize they're in trouble? You know what I mean?
Yeah, I know. Again, there's a certain element of what we talked about earlier, this sort of perhaps false optimism that, they keep sort of like moving things around, and the old robbing Peter to pay Paul kind of thing. And they think, oh, well, things will change, or they have maybe expectations that things will change quicker than they do. And then what ends up happening is that then they hit sort of a wall at some point, and then there's this sort of, awakening that, oh, geez, I'm in trouble here. And we've always said, I would love to see people early on in the process before they get to that point, because we have more options for them if they come in early. Whereas if they only come in when, they get they're served with a notice they're being sued, we've got maybe fewer options at that point to help solve their problems.
Right. Do you get involved at all within the power of sale part of it, or no? You stay far from that?
Well, typically, once a power sale process has been commenced, there's not a lot that we can do to stop it, and unless the mortgage holder is receptive to some sort of a deal. I mean, it's not impossible. There is a form of the proposal process called the Division One proposal that could potentially stop that process and allow some sort of an arrangement or an agreement to come into place. But the thing is that by the time it's gotten to that point, there's maybe some friction between the debtor and his creditors, and they may not be too receptive to something at that point. So, I certainly have had a case though where I've had a bankruptcy, and so when there's been a bankruptcy, technically, again, the house itself, the title to the house would vest with me, with the trustee, with MNP, and at that point, then I'll try to sell the house rather than have it go power sale, because typically we can get a better return from a sale that's not under duress in the same way. And so I'll try to work with the mortgage holders. And for those that know me, I've been in the industry a long time. They're like, yeah, okay, Wes, we're willing to wait. We'll give you some breathing space before we actually pull the trigger here, in order to give you a chance to actually sell the property in the normal course, rather than have it. And then, of course, all the additional legal fees and everything else that they tack on when they have to do that erodes the amount of equity that's possibly available for the other creditors that are out there. So we're trying to find a balance between those things, right?
Yeah, for sure.
Yeah.
I think I'll kind of wrap it up with this last question here. Who knows, it might be a little while to kind of complete it. But in regards to the new tenant bill of rights, I don't know if you've heard about it, that Justin Trudeau recently came out with, where now they want the tenants' rent payments to go towards their credit score. What are your thoughts on that? Do you think it's good? And do you think it's even something that that'll come into play? And I do believe that there's already systems out there that are doing this already anyways.
Yeah, I mean, I haven't dug into that a lot, but this particular aspect of it, the idea that rent payments to a landlord should be something that is updated on the credit bureaus. I think that would be a great idea, frankly.
Yep.
And the reason I say that is because I have had folks who have had fallen on hard times. They've had to file a bankruptcy or something like that, and when they go to re-rent a new location, a new home, they're getting some pushback because, of course, when the landlord does a basic credit check, they see, it looks dark and not a happy situation. And so sometimes they get turned down for rental options that they should otherwise have. And for these folks, they've never missed a rental payment previously, right? So what we oftentimes will suggest to them, and fortunately most landlords are amenable to this, is they go back to the original landlord they had and ask them for a letter of reference to say, look, this person was an awesome tenant. They didn't wreck anything. They always paid their rent on time, and so on and so forth. And then they kind of take that to the new potential landlord and say, hey, look, I know my credit score doesn't look great, but here's something from my last landlord that says that I'm going to be a good tenant. And so if rents were actually something that were updated on the credit bureau, then at least the landlords could look at that and see, well, okay, you don't seem to have ever had any problems with your rents. It's just the other stuff, the credit card bills or what have you, right? So
yeah, I mean that reference letter might help, but I think it's it is slim. Here's the unfortunate part is that my wife was a mortgage agent at one point in time. She's no longer doing it. And, being a landlord, we've put, I would say, many tenants into our properties that didn't have the best credit. But because of the skill set that she had, she could actually properly dive into that credit report to saying, oh, this is not a continual person that continually never makes their payments. There was a small hiccup or a small glitch, and sometimes life just happens. But you have to be able to have the knowledge and the education, I guess, to be able to read those reports properly and really kind of dig into it a little bit more and saying, okay, I see what's happening here. You're actually a good person. Just life happened.
Yeah, and I think that's a key point is that, I mean, and I'm sure you've seen them too. If you go and you get a report from Equifax or whatever, like unless you're used to looking at them, they look like Greek. Like you'd have no idea what you're looking at, right?
Yeah.
And so any layperson that looks at it, they're like, this is sixes and nines. I have no idea what I'm looking at here, right? So for her to be able to kind of delve into it and dissect it a bit and try to figure out what's going on. Now, she was willing to put the time in to do that. A lot of people aren't, and so unfortunately, they sort of like they look at it and go, there's some bad stuff on here. I'm just going to go on to the next applicant or whatever, right? So that's, but I think it is something that is important. And I mean, I would agree with you. I know some folks that own property and are landlords, and they've taken a chance sometimes on somebody that maybe didn't have a stellar credit score, but they've turned out to be great tenants. And in fact, in some ways, the folks, and maybe this comes down to a certain extent to, I don't know, a sixth sense about people when you meet them, maybe, I don't know, but some of these folks were so grateful that they were given a chance. They've gone above and beyond to be better tenants than they might have otherwise been because somebody took a chance on them, right? And they had faith in them. So
yeah, and that's a good point. You're right. We've done that, and you're right. That's exactly what ends up happening. Like, thank you for giving me a chance. We're actually we are good people. It just something happened, and it does work out that way. Believe it or not. But you got to know what you're doing. You got to know how to read that credit report.
Yeah. You got to know how to read the credit report and know how to read people to a certain extent too.
100%. Yeah, both of those. Listen, Wes, I really appreciate your time. This was very educational, even for me as well, too, being in the game as long as I have. And, I appreciate you doing this. And I'm sure that anybody that listens to this will get some good insights on this. And if they're in trouble or they feel like they're maybe potentially going in that path, how can they get a hold of you or contact with you or somebody within MNP?
Yeah. So the first thing they can do is to go to our website and check it out. So it's MNPdebt.ca. And there's information there about, what we do and the processes and how they work and all that kind of thing. If you go there, you can make an inquiry there, which, depending on where you are geographically located, you're going to end up being directed to the closest MNP office. I'm actually the director of consumer insolvency for MNP. And, we have over 80 trustees across Canada. I know all of them personally because we actually make an effort to get together once or twice a year and actually talk shop, things our spouses don't want to hear about, and so, all these folks are great. And so, the other option would be to call 310 debt, which is 310-3328. And wherever you happen to be, you don't even in most cases have to put an area code in front of that. It'll automatically direct your call to the closest MNP office, and you'll get to talk to somebody there that, can help you figure out your situation and find a solution.
Awesome. Listen, Wesley, I appreciate it very much. Thank you for your time. And let's connect again.
Sounds good. It was great being here. Thanks, Gary.
Yeah, take care. Bye.
Bye-bye.